Good morning from our global headquarters here in New York. I'm Menace Crenny. You're welcome to Bloomberg Brief. Let's set that agenda. To the White House and beyond, Elon Musk and Vivek Ramaswamy gear up to join the new administration. President-elect Trump heads to Washington to meet President Biden. Nearing bankruptcy, Spirit Airlines, the talks hit the wall with Frontier on a rescue deal. And Apollo's Scott Kleinman warns we're not done with inflation.
Inflation is not tamed. The Fed can say what it wants. You just have to open your eyes and look around.
Open your eyes, smell the inflation, see it, do whatever you want. But the equity market for the moment has just paused. Is exposure? It's the highest since 2013, according to Citi. But we have the Bank of America Bull Bear indicator. We're not at extremes yet, according to that. We could go further. And the no landing narrative in the Bank of America survey rises to 33% from 14%. Bottom of your screen is Spirit Airlines. We said that we'll talk more about that with one of our reporters, of course, running into the headwinds of trying to avoid bankruptcy, but it looks all but inevitable at this stage, according to reports. Roll it over and have a look at the bond market, because this is where it's shoot first and ask questions later. Now, at the moment, we've some stability, but I can tell you the twos hit the highest level since July last year, and you're seeing yields up yesterday on the threes, the 30s, the very long, up by 10 basis points. So we're just recalibrating right now ahead of the CPI. Your risk is you get a hot CPI, but just bear that in mind from Apollo and from Scott Kleinman. Inflation is not tamed. Dollar yen is on the march. We broke through 155, one double nickel this morning for the first time since July. We've been rising for 3 days on the dollar. I mean, the dollar is surging. It's the highest in 2 years. So you're going to start to hear the intervention narrative again. The Ministry of Finance will probably begin the jawboning, but some of the markets say you're going to get all the way up to 160 before you see any kind of intervention. Let's take some of those thoughts to Mads Pedersen of Edge Investment Technology, writing this. Trump wants to invest and spend. This will be inflationary, but not as inflationary as Biden's politics ended up being. The architect of what we see as a policy created inflation was the FOMC, and the ex-FOMC chair, who in her role as Treasury Secretary argued for running the economy hot. Mads joins me now. Mads, thank you so much for being with me this morning. Charlie Evans was with us yesterday in conversation. He said when he was on the Fed, they hadn't quite anticipated the inflation that they would get. When you look at the landscape, we still have a lot of pieces of information to get. What scale of inflation are you expecting? And do you think it could be as virulent, perhaps, as some of the worst suggestions from the bond market?
I don't think it's going to be as virulent as the worst suggestions from the bond market. I think inflation is more or less under control, meaning if it moves up 0.5% from here, it will scare the bond market, but it will not matter much for the economy compared to what we saw under Biden and Yellen's combined effort with the FOMC to run the economy hot. So I think we have to remember monetary policy is still quite tight. So there's a pressure down on inflation already now, and we're talking about taking off that pressure. So I think inflation will be between 1.5% and 3% in the coming 4 years, and I think it will be the same in the coming 1 year.
The narrative that I'm hearing from Scott Bessent, who might be Treasury Secretary, is talking about making savings over a 10-year period. You listen to Elon Musk, who's on his way to Washington for a role in how to make government efficient. OK, he branded around $2 trillion on a stage. But there's an interesting narrative from Bessent and Musk and others about perhaps a little bit more aggressive hold on costs.
That would be absolutely positive. I think the one thing which we have missed around the world the last 10 years is a hold on cost. The one thing everyone has done is overspending. It's everyone from Germany, France, my little Danish country, even the Swiss think the government has been a bit overspending, which is not the case. And the US has definitely been on the high spending side. If we get rates down, and credit spreads are very low now, very tight, yeah? If we get rates down, you can get growth without spending quite as much on the fiscal side. That would be very good. That would be very positive. It's not exactly what the incoming president has been promising, but we hope that he will listen to his very competent advisor here and actually tighten a little bit so that we don't get this thing spiraling out of control.
Well, the one thing that he does, we know that this president does pay attention to, is the stock market and the prices therein. Before the election, you shifted an additional 10% into large cap equities. You've been pretty much an Uber bull all the way through every time we've caught up with you on Bloomberg Brief. To what extent are you reaching beyond that large cap world? Because if I go back to 2016 and I look for the redux there, it was Russell 2000 that put on 14% and small caps that put on 16% between election and the end of the year. I know we've done a lot.
Yeah, I think we have done too much to go into additional beta in my portfolio. I'm 40% over with equities compared to 60. So I think the next move we will be making is actually taking off 40%. It's not time yet, but it could be time, and I encourage everyone to have a plan for that. I think rather than dipping further into higher beta by buying small cap or adding to our already significant weight in technology, we are more thinking this looks good. It can run somewhat further, but the next big move is going to be a risk reduction on our side, is my expectation.
Do you think the next big move in markets is a risk reduction when they see the first salvo of tariffs, when they see the first narrative and oratory from the Trump White House? Do we have time between now and, let's say, the end of Q1 to remain long and strong?
Well, we remain long and strong for now, so we feel we have time. We think we have time. Our algorithms tell us we have time. Credit spreads they were tight. They are at the tightest they have been for a long time. So we think we're going to see a situation where earnings will surprise positively, also in fourth quarter, that we're going to get reports for in the first quarter. And after that, there's a lot of risk, because if you like Trump or if you don't like Trump, he's going to be in place. He's going to have done a lot of what you like if you like him, and he's going to have done a lot of what you don't like if you don't like him. Yeah, that's not my job to decide. But he's going to have done a lot of the things. And what's then going to take it further? Remember, S&P is up about 640–50% the last 20 years. It's the last 10 years. It's a lot. It's more than 10% a year, and it cannot continue.
What's the best hedge then? If you think the next material move is to the left tail rather than to the right tail, what is the hedge in that case?
So the big question is, how do you time the time you buy decent duration government bond or other AAA assets? Because as you rightly said earlier, we have seen the 10-year move up, we have seen the 5-year move up, we've seen the 2-year move up. So there is a chance, which we haven't had for a long time with big risk reductions, to buy the US Treasury. If we even get a Treasury Secretary who's considering actually fixing the fiscal problem, I don't think it's the end of the world, the problem, but there's a fiscal problem. If we see a secretary who's focusing on fixing that, then the US Treasury is very attractive. The problem is the last 2 years, everyone who tried to buy that duration burned their fingers, and they did the last 2 months as well. So we need to find the right time and the right duration to buy. And then it's AAA rated assets, so like development bank bonds, or it's US Treasuries. You can discuss what the rating should be, but they're safer than any other government bonds. And those are the ones we're going to be looking to buy.
Look, whilst I have put forward what Musk is saying on a stage and what Pedersen is saying on a podcast, and if he does become Treasury Secretary, there's no doubt about it, the fiscal numbers that we've run is that under a Trump presidency, if they execute everything that he promised, and that's a lot, then you're looking at, yeah, it's a heck of a lot. And we probably won't get that, 7.75 trillion. My risk reward in bonds, Mads, is it really to buy bonds at these levels with the risk of that fiscal largesse, which was promised?
No, not if Trump does everything he promised. But I don't think Trump has ever done everything he promised. I don't think that we have seen ever. So I don't think he will do it this time either.
OK, well, we'll see who else is approved for cabinet, and then it will begin to take shape. Mads Pedersen of Edge Investment Technology. A little bit of breaking news for you on Bloomberg this morning. We have Senator Elizabeth Warren is set to become the top Democrat on the banking panel. Warren is to succeed Sherrod Brown on the Senate panel, so that's going to set up for an interesting discussion when it comes to deregulation in the banking industry, as has been much promised and priced by the markets. There are other stories trending on your Bloomberg terminal. This is what we've got for you. Seven & I is considering a management buyout to take itself private. The deal's worth $58 billion. That's according to Bloomberg. Talks are ongoing, and the deal could be difficult given this size. It also may not proceed if Couche-Tard rescinds its proposal to buy Seven & I. Swedish payments firm Klarna is filing for a US IPO after months of speculation. The number of shares to be offered and the price range have not yet been determined, but analysts estimate Klarna's implied valuation somewhere around $14.6 billion. Just Eat Takeaway is selling Grubhub to Wonder for $650 million, a steep discount to the $7.3 billion price tag it commanded during the early days of the pandemic. Wonder will pay $142 million in cash and take on $500 million in Grubhub debt, and the deal is expected to complete in the first quarter of 2025. Coming up in the show, President-elect gathers his loyalists as cabinet picks roll in. More on that. And we count down to the latest inflation data with Citi's Veronica Clark in just under an hour, right here on Bloomberg. It's Bloomberg Brief. I'm Menace Cranny here in New York. President-elect Donald Trump has announced that his billionaire backer, Elon Musk, as well as the former Republican primaries rival, Vivek Ramaswamy, will lead a Department of Government Efficiency. Part of the Save America movement, Musk is quoted in the statement as saying this will send shockwaves through the system and anyone involved in government waste. Joining us now for the latest incoming cabinet picks and perhaps a bit of chaos ahead of us, it is Kevin Whitelaw. Kevin, good to see you. So this department proposed by Musk and Trump before the election. We've heard lots of numbers bandied around about Save America. What is the reality of the scale of fraud, as is said here, fraud and improper payments that can be dismantled? What's the scale of change that we can look at?
Well, you know, I think that this is something that administrations over the years have come in and talked about. Vice President Al Gore was at one point in charge of a similar kind of operation back during the Clinton administration. The numbers really don't add up in any way to the kind of scale he's talking about unless you're really talking about stripping away at some of the fundamental programs that are supporting Americans, such as Social Security and various health insurance, Medicare, Medicaid. He's talking about $2 trillion. That's much bigger than the discretionary budget of the U.S. government in any given year. So there's essentially no way to accomplish it without hitting defense spending, without hitting programs of various kinds. So certainly not just waste and fraud. It would have to go deeper and really reshape, sort of what the actual role of government is in society. So we'll see if it actually goes that far. And obviously, Congress would have to go along with it. And a lot of folks in Capitol Hill, including Republicans, have a lot of stake in a lot of the programs and a lot of the spending that goes through there. Okay, so it's not going to be as easy, perhaps, as the hubris of being on stage. Senate returns today, and we've just announced the news there that Elizabeth Warren will succeed Sherrod Brown on the Senate Banking Committee. Picking a new Senate leader, Mitch McConnell is on his way out. What's the running and riders for the Republicans? Well, it's going to be an interesting contest because in a normal sort of universe, I think the two sort of McConnell deputies, John Thune of South Dakota and John Cornyn of Texas, would be really the ones that would be the favorites, the ones vying for it, and would have by far the best sort of chance from inside the chamber and inside the Republican sort of caucus there. But Rick Scott of Florida does appear to be Trump's choice. He's the one who sort of made the most noise about going along with Trump's demand for recess appointments, something the Senate hasn't allowed in years, which because it's a process that involves giving up Senate approval of nominees. So we'll have to see whether Scott can actually break through or not, but it will be a very early test of the amount of control that Trump is going to have over that chamber. Well, what is it? Rick Scott said he has Trump, Elon Musk, and Tucker Carlson are all supporting me. So it's interesting who he's saying are in his camp. Let's just round it off. I mean, we're getting name after name after name, but we understand that Trump has picked former Fox News host and Army National Guard officer Pete Hegseth as his defense secretary. Now, this man is well qualified in terms of academia and in terms of his tours of active duty. What do you think the main driver for Trump here is in terms of background in the military or other issues? I mean, I think it's twofold. One is simple loyalty, and Trump is showing that loyalty is by far the most important thing in all of his picks so far. And the second is someone who's good on TV. A lot of the way that Trump appears to be evaluating these nominees is by simply watching them on TV, watching their clips, watching how they do, and watching how they deliver his message. Normally, when people are trying to choose someone to run the Pentagon, which is one of the biggest bureaucracies in the world, has an unbelievably complex set of operations, personnel, missions, and facilities, you pick someone who has a certain amount of managerial experience. That does appear to be entirely lacking from the biography of Pete Hegseth. So Trump's clearly going in a very different direction with the way he went through this particular pick, and I think it's already unsettling both people inside the Pentagon and the military, but also on Capitol Hill.
Okay, well, let's see the other names that come through, and of course, whether they get approved. That is going to be the telling moment. Kevin, thank you very much. Kevin Whitelaw on the Trump appointments, which are coming in hard and fast. Coming up on the show, Spirit Airlines getting hit in the pre-market session. Reports are that it is nearing bankruptcy. More on the story. The stock is down 61% unchanged. It's Bloomberg Brief. I'm Manus Cranny, right here in New York. Shares in Spirit are tanking, as we've shown you pre-market. The airline is said to be nearing bankruptcy after discussions for a tie-up with the rival Frontier. They fell apart, and it's now in talks with the note holders on its debt. Sid Phillip joins us now. Sid, here we are. It's now down to a question of whether bondholders do a deal. What does that mean for equity holders? Is it wipeout?
It would potentially wipe out the equity holders. I mean, Spirit Airlines said as much, that any deal with the creditors would wipe out their equity holders. And so essentially this would basically mean that Spirit Airlines can get rid of about $1.5 billion of debt that's coming due in 25 and 26. They can restructure the debt, and they can then carry on as a new entity, essentially going into the business that they've been in.
What does it do for customers? I'm just looking at some of the analysts. TD Cowen are saying it creates risk for customers booking away from the airline, resulting in even greater pressure. So this is like the self-fulfilling vortex, the doom loop.
It does. It does create a sort of vicious cycle for the airline, because essentially customers are less certain about their bookings, and they may sort of hold off on bookings, which would then make it much more harder for Spirit to actually emerge from this potential Chapter 11 process and actually sort of keep going as a viable carrier. The airline has cautioned that essentially unsecured creditors, including aircraft lessors as well as customers, would not be impacted by this process. And so that would sort of give them a sort of sense of relief, but at the same time, airline customers tend to be sort of very temperamental, and they look at sort of what their potential is if they're booking months in advance, whether they can actually get their flight, and that will be one of the crucial factors in deciding bookings, and that could potentially upset bookings and forward bookings for Spirit Airlines.
Look, Sid, just one sort of blue sky thought. We're going into a new presidential regime here in the United States of America, one that one would assume is going to be friendlier to M&A deals. I mean, when Biden killed the deal between JetBlue and Spirit, he said this was a win for American consumers and competition. Briefly, do you think that we're going to go into a regime change in M&A?
There is a lot of speculation that there will be more M&A, and there will be more M&A opportunities for the airline industry. I mean, the consolidation hasn't really moved ahead. I mean, we've seen the Hawaii and Alaska deal go through, but other deals, including JetBlue's partnership with American Airlines, was also blocked on antitrust grounds. So it will be interesting to see what the airlines do and what the potential combinations are, and what the new administration actually determines is the best course for action in terms of whether or not they approve these M&As and whether or not they allow the creation of much larger airlines that can challenge the big four in America, including United, Delta, Southwest, and American Airlines.
Well, certainly if you take the narrative from Trump, America first, America strong, it could well be a little bit of a different regime. Sid, thank you very much. Sid Phillip on the very latest with Spirit Airlines. Let me take you through some of the front pages on the rest of the world. This is what we've got for you. First up, the Associated Press talks about President-elect Trump heading to Washington to meet President Biden. the White House. Now, the two will meet in the Oval Office at around 11 a.m. Trump also planning to meet with Republicans from Congress as they focus on day one priorities. Next up, Bloomberg leads with Man Group planning a round of job cuts as it reviews its staffing needs. The review will lead to job cuts in low single-digit percentage terms. Now, the cuts will mainly focus on operations, middle office and technology roles. And the Journal leads with Volkswagen increasing its investment in Rivian by $800 million. In return, the German company gets access to a blend of Rivian's onboard computing and software. The deal highlights the depth of the challenges they face in the race to compete with Tesla and the Chinese competitors. Currency market is powering ahead. You've seen this strength in the dollar at a 2-year high. It just comes back to flat at the moment. But dollar yen, we did make it through 155. Will we re-attack the upper levels? Let's see. From our global headquarters in New York. Welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. To the White House and beyond, Elon Musk and Vivek Ramaswamy gear up to join the new administration as President-elect Trump heads to Washington to meet President Biden. Nearing bankruptcy, Spirit Airlines, the talks hit the wall with Frontier on a rescue deal. And Apollo's Scott Kleiman warns we're not done with inflation. More on that exclusive interview from Danny Berger in just a moment as we count down to the CPI. Good morning to you. We're pausing for breath in these equity markets, down an eighth of 1%, but we're still holding above that magical psychological level of 6,000. Spirit Airlines tanking by over 61% as they career towards bankruptcy. But the question is this, as to whether this equity market is, is the exposure so long that there's nowhere else to go. We just heard from Mads Pedersen that the next material move in this equity market is down. You want to take some money off the table. However, then I look at Bank of America, the bull-bear indicator, it's on the rise. It's not at extreme levels. And as for no landing, well, that moves from 14% to 33% in terms of the fund manager survey. But perhaps the unease is in the bond market. This is where you saw the two spike higher yesterday to the highest since July. It was timely that Danny sat down with Kleinman over at Apollo, telling the market and telling the world, more on this in a moment, that, we're not vanquished on inflation yet. The issue for the market is this today. CPI could be hot, expected to be a little bit hotter than normal. The market is shaving back its December bets, and that is the critically important point here. 441 is where we are on 10-year bonds at the moment. And that latest read on the US inflation is due in 3 hours' time, actually. So we will count you down to that on surveillance. Now, Apollo's Scott Kleiman told my co-host Danny Berger that the Fed's fight against rising prices, well, it's not over yet.
Inflation is not tamed. The Fed can say what it wants. You just have to open your eyes and look around. Think about the last flight you were on and how crowded it was, or the fact that you're paying $85 for a steak and next week it'll probably be $90. Or housing prices, right? Everywhere people want to live, right, there's not enough homes. Housing prices are going up. We see inflation not as beaten, but as suppressed. And the more the Fed cuts, the more you're lifting your hand off that lever to hold inflation down.
Joining me now, Veronica Clark, economist over at Citi. I want to have a steak at $90 where Scott Kleiman is. But on a serious note, I think it's one of the most honest appraisals of the real economy. Open your eyes. There is this difference between what the Fed is saying and thinking and what the reality is. And I think Kleiman very much brought reality home to bear yesterday.
Yeah, in some ways I would agree and disagree, of course.
Let's go.
I think there's maybe 3 different time frames we need to look at in terms of some of the inflation data. Very short time frame, of course. Today we might get a hotter CPI reading. Of course, the Fed is going to be very reactive to those individual monthly prints. More medium term, I do see a lot of disinflationary pressures still. The labor market has loosened. A couple weeks ago, we got an employment cost reading for the third quarter that looked pretty normal. It was the softest in a while. Home prices are pretty subdued. We see that in the monthly Case-Shiller data. They'll probably stay that way with higher rates. But longer term, I can see inflationary pressures coming back for sure.
And that may well come from fiscal and immigration policy. Let's just disaggregate a little bit of what you said. Somebody's out of kilter here. either Apollo is out of kilter or the economists are out of kilter. But you warned very clearly, we are in a slowing trajectory in this labor market, and that long variable lag has yet to bite.
Right. I think it's maybe starting to. I mean, we certainly see weakness in the rate-sensitive sectors like housing and manufacturing, even small businesses that are going to be more rate-sensitive. We do see, demand slowing in those sectors. Certainly, the larger corporates, higher-income individuals are doing well. But I do think, the increase in the unemployment rate is telling you that this is a looser labor market than even 2019. Chair Powell says that also. I don't think the Fed is going to be particularly concerned about those high-level drivers of inflation in the next year.
So when you listen to the data sweep that you've just given me, that would take me to a 25 basis point cut in December. Additional hedge, additional insurance. Yet this market, it's a toss of a coin, and 50-50. In other words, they're shaving back quite furiously in terms of that. Can you see the narrative for a pause, despite what Kashkari said yesterday?
Yeah, it's going to depend on the data, of course. It will depend, of course, on today's CPI reading. Will depend very heavily, I think, on the next employment report. We'll get that November employment data, I think, the day before the Fed's blackout period. That's going to be a really important one. But yeah, I mean, there, of course, is a scenario where inflation is still maybe a bit uncomfortably high and they do pause. But I do think, this would be a pause amidst a broader cycle, getting at least back to neutral because the labor market has weakened, and that's a really important point to remember. It's not just about inflation here.
I look at this bond market, and what goes through my mind is it's kind of shoot first and ask questions later at the moment, isn't it?
Yeah, we're very reactive to whatever the latest data point is. The narrative of the last 6 weeks, of course, has been this, reinflation. Activity is strong. It really started with that strong September employment report. Of course, looking forward maybe to post-election policies. But for the Fed, they're going to be reactive to what current conditions are, current data, not necessarily preemptive in reacting to hypothetical policies that might not happen yet.
Agreed. 3.3% on core CPI today. You say don't get too ruffled by it. Disinflation, the train of disinflation remains for you despite that 3.3% if that's what we get.
Yeah, for the next year
at least,
I think so. Yeah, I mean, we do think that it's a cycle, a normal cycle. It's taking a lot longer to play out, but the labor market is loosening, housing is weak. This is evolving like a normal cycle, and you can get something that looks like 2% inflation in the next year.
When we talk about the challenges for the Fed, it's about comprehending policy that they don't have detail on yet. You listened to Kleiman in that interview yesterday. He said the economy has done pretty well in an anti-business environment from a regulatory perspective. If we go through into 2025, we can assume, A, we're going to get some kind of fiscal stimulus, some kind of tax cuts, and some kind of shift on regulation. So the landscape for growth is pretty solid. Is it into 2025 in your perspective, or is it challenged?
Yeah, I think it's a bit more complicated. I don't think we can just look at the 2016 playbook and assume that this is going to be the same kind of positive growth environment. We will get maybe some corporate tax cuts, right? But we already got the big ones in 2017. We'll get the extension of the individual tax cuts, but that's not so much growth positive as it would be just negative if we let those expire. Certainly, we're looking at wider deficits, deregulation can be growth positive, but a lot of the support for the economy over the last year has come from maybe stimulative fiscal policies, Inflation Reduction Act, the infrastructure, and if some of those policies are rolled back, that would have the opposite impact.
So those are the headwinds. That's a recalibration of the verbiage that we've been coming out with. Then, if tariffs are implemented, there's boomerang. Nobody's going to sit by and just let America slap tariffs on them and sit idly by. Just run me through your thinking in terms of the blowback from the rest of the world. Yeah,
I mean, I do think a lot of the tariff policy will maybe be a negotiation tool, so we don't exactly know what it will look like. But certainly in the 2018 tariffs, we did get retaliatory tariffs on things like soybeans, for instance. So yeah, we really just don't know what will evolve yet.
And in terms of the most optimistic view for 2025, I've talked about this with our last guest and with our politics reporter. You've got Musk and you have Vivek going to, as it were, recalibrate efficiency within government. We don't know what that quite means. But then, and I'm very focused on this, Scott Bessent, potentially Treasury Secretary, talking about, again, taking inefficiencies and costs out and cutting spending. Maybe this is the more under-talked about tail risk.
Yeah, no, I think I would agree with that. I think certainly the market has looked at the election outcome and is presuming wider deficits, which I think most people would agree with. But maybe we do get a lot of cuts to fiscal spend. Tariffs do raise revenue. Maybe the deficit impact isn't as much as we're expecting. In which case, yeah, you would get rates pulling back again, maybe.
And I'll leave you with a thought on what he actually said. It was basically, I think we could get $100 billion a year over 10 years. That's $1 trillion in this cockamamie CBO scoring, and that will stabilize the bond markets. So let's see. Pedersen is a market participant and well known and understands the bond market very well. Veronica, thank you very much for coming down to CPI. We'll take you through those numbers a little bit later on. And you don't want to miss, we've got an interview with the Minneapolis Fed President Neil Kashkari himself. He joins the Bloomberg team a little bit later on as the US CPI print drops at 8:30 a.m. The surveillance team will take you through that. Coming up, President-elect Trump gathers his loyalists as cabinet picks roll in. More on the state of play on Bloomberg Brief. Today's your Bloomberg Brief. I'm Manish Graney here in New York. Entrepreneurs join the president-elect Donald Trump's cabinet lineup. Elon Musk and Vivek Ramaswamy have been tapped to lead a new Department of Government Efficiency, DOGE for those who don't know. Part of his Save America movement, Musk is quoted as saying this: "This will send shockwaves through the system and anyone involved in government waste." Let's bring in our Bloomberg government reporter. It is Kate Ackley on this. Kate, the department was proposed by Musk and Trump before the election. You saw you saw Musk jumping up and down on a stage going, "We're going to save $2 trillion." I mean, these numbers are staggering, but the reality of maybe what they can achieve. Can you just talk me through about what we know about this so far?
Absolutely. I mean, I think the business sector that, is affected by a lot of these government regulations is sort of bracing for an era of disruption with Musk and Ramaswamy and others, joining the administration or advising the incoming administration in some way. But I think even with the announcement yesterday, the official announcement of this, there's still more questions than answers. It made it sound like Musk and Ramaswamy would be outside advisors and would partner with the Office of Management and Budget. That was in the, in that release. So what does that mean? And, does it mean that Musk doesn't have to leave his, Tesla or SpaceX, but does this as a kind of side project? And how does that all work? I mean, is this really a new department? Will Congress be standing up a new piece of the federal government? Or is this going to be sort of more of a project that Musk and Ramaswamy and others, give advice to OMB and people in the administration?
Well, I suppose if you look at what he did with X when he joined that, I don't necessarily know one can get to that level of chaos of restructuring. By the way, the government spends $6.75 trillion. A lot of that goes on Social Security, healthcare, defense. So Congress is going to have something to say on this, as well as veterans, in terms of where you take that money from. Let's talk about the Senate. We've got senators voting for a new leader today. It's going to be the first time in 2 decades. Mitch McConnell moves along. So who is the hottest ticket for that leadership race?
Well, there are 3 contenders, and this is a closed door secret ballot. So, outsiders, and there are people on the Trump team that have weighed in. They like Florida Senator Rick Scott. That's who sort of Team Trump is pushing for. But you have 2 longtime senators seen probably as the front runners. I would say in my conversations with people that the big front runner is Senator John Thune, who's been in the Senate, for a couple decades, and has just been seen as a rising star since day one when he got there. Has a lot of ties in the business community. He's actually a former lobbyist from between his time serving in the House and the Senate. And then Senator John Cornyn from Texas. Both of them are huge fundraisers. Cornyn, I think, has had bigger fundraising. If you look at over recent years, Thune really stepped up his fundraising. Not that that's the only thing, but you know, when you go into these battleground districts, some of the new senators they have, the Republicans that have just been elected, you know, have gotten to know these leadership contenders who were there helping them raise money in their own races.
Well, Rick Scott has come out and said he's got Trump, Elon Musk, Tucker Carlson all supporting him. So let's see where that secret ballot goes to. Kate, thank you very much. Kate Ackley getting up early again in Washington. One stock we are tracking through the morning pre-market at 5:46 a.m. is Spirit Airlines, down 64%. Continues to slide. As it said, it is near to bankruptcy, according to Bloomberg sources, after discussions for a tie-up with a rival, Frontier, fell apart. Benny Camel joins us now. Benny, look, Spirit, it's pretty much in an awkward spot here. It's got debt. It's got to negotiate with the bondholders. It looks like an equity market wipeout, and the bondholders may get a haircut.
Yeah, you're absolutely right. So this is a company that's been in crisis mode for a while, and they're trying to chart a path forward here. We know that they, at the start of the year, for a while, had tried to find a partner. The partnership with JetBlue, that was blocked at the start of the year because of antitrust concerns. They then turned to Frontier, another ultra-low-cost company, and that was seen as a more viable option because that's a smaller company. There wouldn't have been the same kind of regulatory hurdles. But we're hearing that too might have fallen through. So really, at this point, they're in a dire spot. They're bleeding cash. They're actually not in position, they said yesterday, to release their latest earnings. And the path forward really might be what you described, some sort of a Chapter 11 bankruptcy filing, and that would wipe out equity holders. But it might be a chance for the company to start over.
Well, they certainly tried, haven't they? I mean, with JetBlue, that deal was pushed away by regulators. Any other chance of, as it were, as a white knight riding in here? Or is it this is the last-ditch attempt? I mean, will the customers still book with it? That's the doom loop. That's the risk here, isn't it?
Yeah, you're absolutely right. That's always the risk with airlines because, you know, if you're a customer, you're buying a ticket not for tomorrow, you're buying it further out, and you want to feel good about being able to actually use and board that flight. And if a company files for bankruptcy in an airline, it doesn't mean that they will go out of business, but, you know, to use your doom loop analogy, we will probably see more people saying, you know what, it's too risky for me, there are options out there, I might go somewhere else. They might lose pilots, they might lose staff. So holding the business together under a circumstance like this is going to be very difficult for the company.
Benny, thank you very much. Benedict Camel there tracking the Spirit Airlines story. CPI is coming at 8:30 a.m. a little bit later on. Our very own Danny Berger spoke exclusively to the Apollo co-president, Scott Kleinman, as the markets await the latest read on inflation. Let's take a listen.
I think rates are going to be higher for longer because inflation is not tamed. You know, the Fed can say what it wants. You know, you just have to open your eyes and look around. You know, think about the last flight you were on and how crowded it was, or the fact that you're paying $85 for a steak and next week it'll probably be $90. You know, or housing prices, right? Everywhere people want to live, right, there's not enough homes. Housing prices are going up, notwithstanding, you know, the backdrop of the rate environment. And so we see inflation not as beaten, but as suppressed. And the more the Fed cuts, the more you're lifting your hand off that lever to hold inflation down. And look, nobody's got a crystal ball, but you know, we live in a world that is the mega trends that are driving the world today are pretty inflationary. You have things like the build out of the digital infrastructure. So between, you know, chip fabs and data centers and the power that's needed, I mean, that's $100 trillion we have to spend over the next decade. You know, decarbonization, the deglobalization of the economy, all of these things are inherently very inflationary. Then layer on top of that what might be, you know, some of the new administration's policies that are, you know, that sound inflationary, you know, deficit spending, so some of these other programs that are going to add to inflation. It's very hard to say that inflation is beaten or inflation is over. That doesn't mean inflation is going to run away. It just means we're going to have to live with a higher rate environment for a lot longer.
And you've been really good and really right on this idea that we're going to have a higher rate environment. And one of the things you said, at a conference in Berlin this year, in what feels like a lifetime ago in June, is that not everything is going to be okay, that we're going to have some refinancing coming into the market, and it's going to be a problem for a lot of private capital. Again, that was in June. Is the moment of reckoning nigh now?
For sure. I mean, we're getting closer and closer to this. As I alluded to back then, the private equity industry, invested in a lot of companies, over the 5 years leading up to 2022, before the rate change happened. Good companies, but at very full prices. So sitting here today, when private equity companies firms would be normally selling their portfolios, they're stuck. They're holding on to big portfolios of good companies, right? I'll posit that most of these investments are good investments. They just paid too much for them given the current rate environment. And so they are saleable, but maybe not at prices that these private equity firms would be happy with. And so they're going to hold on to them. And by holding on to them, you have grumpy LPs who aren't getting their cash back at the rate they thought. And then you also have refinancing issues, right? Okay, well, now if I'm holding this longer, I have to refinance it. And so how do I do that? Some companies will have no problem. Others will have to start being a little more creative. And we're absolutely seeing that. Part of our business model is to help those companies, other sponsors that might need capital somewhere in their capital structure to help get through this next hump. Because again, most of these companies are actually good companies. The sponsor just paid the wrong price for it.
Is the matter made even worse at this moment, though, than it looked in June, considering we might have more inflationary policies coming in 2025?
I think it only lends credence to my theory. We'll put it that way.
Great exclusive conversation there by Danny, my co-host with the Apollo co-president, Scott Kleinman there. And really, in the eye of that spike higher in yields yesterday, inflation is not tamed. Coming up, we'll take you through your trading day, set you up, the key data. President Biden, of course, meeting his successor in the Oval Office. We'll take you through the agenda in just a moment. Day ahead looks like this. We're counting down to the CPI, 8:30 a.m., expecting 3.3% on the core number. Don't miss our interview. We've got the Minneapolis Fed President Neil Kashkari. That is just after 8:30 a.m. Plus, President Biden and President-elect Trump will meet at the Oval Office at 11 a.m. When it comes to understanding these markets, it's still ground zero. It is the dollar that is on fire, and the dollar is on fire against the yen very specifically. You can see they're up for a third day. We broke through 155 a little bit earlier on the day. We're back at that level. When do we get the intervention? That's it for Bloomberg Brief. Surveillance is right up ahead.